Let's connect with Rana Kapoor, founder and managing director and chief executive officer of Yes Bank. Mr. Kapoor, good morning. Thank you for joining us. Before I look at specifics, first let's characterize the big picture for us. What were the main drivers for your profit growth for the quarter gone by, and how have net interest margins and net income panned out for Yes Bank for the quarter gone by?
If you see, the overall net interest income of the bank has gone up by almost 30%, and non-interest income is over 37%. This has been driven by fairly modest growth in loan assets, and also some growth in credit substitutes, particularly our corporate bond portfolio. So overall credit substitute growth is at 20.5%. Whereas our overall profit after tax is improved by 34.4%. So if you see that the P&L stretch, the P&L outcomes are a consequence of productivity gains, far more efficiency, far more business velocity in our branches, significant improvement in our CASA levels from around 10.5% to 15%, overall preserving our net interest margins at 2.8%. So overall, it's been a very satisfactory report card in a year which had a lot of systemic risks, macroeconomic as well as socio-political. So we actually consolidated our balance sheet performance. We sold down certain bulky loans. We did not add high-cost deposits in what is expected to be a declining interest rate market at some point later this year, and at the same time we were able to get a lot more elasticity in our P&L, and we'll probably continue with a similar strategy this year and get more efficiency and productivity gains in our banking.
So Mr. Kapoor, what is your outlook on margins, especially in the backdrop of the rate cut being announced by the Reserve Bank?
Our sense is that preserving margins at a level of around 2.8 to 2.9% is certainly our outlook for the next 2 quarters. With the liquidity situation improving, with hopefully further reduction in repo rates and adjustment in CRR, OMO interventions, it's expected that we will see a lower interest rate regime in the second half of fiscal 12-13. Which basically for Yes Bank implies an improvement in net interest margins, given the fact that we have an overall 60-odd% floating rate book, and our deposit structure, at least as far as fixed deposits are concerned, is generally short. So we do expect margins to possibly improve to a level of around 3% by end of fiscal 12-13.
Mr. Kapoor, Yes Bank has also seen a jump in its non-interest income. What is your outlook for net interest income for Yes Bank for this fiscal, which is FY13?
For fiscal 11-12, our overall non-interest income has been at a level of 34.5% of total net income. So anywhere between 33 to 35% should be the overall contribution of non-interest income to net income. The important point here is that we are getting a lot more granularity in the non-interest income flows from financial advisory, including treasury distribution, particularly a debt capital markets business. We are seeing a fair amount of granularity in our transactional banking business, particularly trade finance. And the good thing is that the retail fee contribution, distribution, loan related, is also picking up. And the most important change in the bank in the last 1 year has been the overall increase in our retail asset book to a level of 18.2% of total loans, what was just about over 5% 2 years ago. Similarly, on the liability side, retail and CASA has improved to a level of approximately 33%, what used to be slightly more than 23.5% about 2 years ago. So retail is the big shift in our business model, and far more liability and asset product introductions have been made, and savings has been a tremendous blessing for Yes Bank with deregulation, 7% interest rates. We've seen an increase in our SA balances of over 202% in the last 1 year.
Mr. Kapoor, what is your outlook on interest rates? I mean, how long before we see Yes Bank cut its lending rate? How sustainable would the 7% savings rate product be in a falling interest rate scenario?
Well, if you see that the overall atmospherics are building up for rate correction downwards, starting with adjustment in deposit rates, especially at the wholesale end. So we are already seeing some correction on that particular front. This will gradually transmit also to retail depositors. So I expect at least a 0.5% correction over the next 3 months on retail and wholesale deposits. And this will migrate sooner than later also to consumer loans and SME and mid-size corporate loans. Next 90 days should see an adjustment of at least 0.5% on both liabilities as well as on overall lending rates. As far as our SA proposition at 7% and 6% is concerned, this is a long-term decision that ALCO has made because we see savings accounts as a major pulling factor and then also to give a good inflation-adjusted or inflation-plus returns to depositors, because these depositors also allow us to sell more retail asset product as in loan product, as well as also provide opportunities for distribution of insurance and mutual funds. So savings at 7% is a rate that we want to anchor for quite some time to come.
Mr. Kapoor, I'll blend 2 or 3 points into one. First, what is your sense on asset quality for both Yes Bank and then for the industry? Also, what kind of exposure do you have to sectors like telecom and aviation? And after the recent TRAI recommendations, are you willing to lend more to telecom companies?
So my sense is that the systemic risks in certain segments, particularly as we know in infrastructure, have perpetuated over the last 12 to 18 months, and it will be a while before these risks are mitigated in the system as a whole, because these need policy interventions as well as some restructurings, and that number is swelling as far as the larger players in the market is concerned. In specific Yes Bank terms, we are very conscious of preserving asset quality. It's absolutely risk management is the nerve center of the bank, and we will not compromise whatsoever. We will adjust growth, but we will not compromise on risk quality. With overall net NPAs at only 5 basis points and gross NPAs at 22 basis points, provisioning coverage of almost 79+%. It's important that these buffers are kept in times of, let's say, exogenous as well as macroeconomic challenges. So risk management is really center stage in banks and will continue in the course of this year. So preserving asset quality is going to be very important here.
Okay, Mr. Kapoor, appreciate you taking the time out and joining us today on the show.